So let's get started. At Oakmark, our investment philosophy, as Graham indicated, relies on three criteria, and we look for all three to be present in any company we consider investing in. We want to buy at a significant discount to our estimate of intrinsic value. We want companies that are expected to grow per share value over time, at least as fast as the S&P 500. And we want to invest with management teams that think and act like owners. So when they face difficult decisions about how to invest their capital, how to handle an acquisition opportunity, or maybe even the opportunity to sell their own company, we want them to behave like an owner, not like a professional manager. And it's only when all three of these criteria are present that we're able to take advantage of what I think is our biggest competitive advantage, and that's our very long-term time horizon. At Oakmark, we invest looking forward about 7 years. We try to forecast how a company will be different at the end of the 7 years than it is today, how investor perceptions might change, and what that would mean for the stock price. I like to refer to what we do at Oakmark is we take a private equity perspective to public equity investing. So when you think about what private equity investors do, they want to buy companies today that they think they can change and at some point in the future bring back to the public market when it's easier for investors to understand the full business value of the company that they've acquired. We want to do that, but within the public markets. We don't want to have to be involved in changing out management teams. We want to invest with people that are already oriented to maximize long-term business value. So let's talk about how we think about determining intrinsic value. There are lots of ways that you can talk about value. Some of our peers in the industry would talk about like price to book value or PE ratio as the primary determinants of business value. We like to think a little more broadly than that. And to us, full value is the maximum price an all-cash buyer could pay to buy the entire business and still earn an adequate return on their investment. So with this an important consideration for us, we spend a lot of time following what's going on in the private market. When a company is acquired, especially by an all-cash buyer, we keep a database on those acquisitions, and then we try to compare public companies to the closest peers that have been taken private and use those to help us figure out what we think the business value of the public company is. I think it's important to say that at Oakmark, we work very hard to not get boxed in on any specific business value estimate. There are some companies like banks that we think book value is a good indicator of what the business is worth. There are some traditional consumer companies that PE ratio might be a good indicator. But then there are other companies that are at different stages of their life cycle where we have to think more creatively about the right business value benchmark. And importantly, we give our analysts the freedom to identify the benchmark that they think best estimates value for any company that they're looking at. So it might be a price to subscriber, a price to sales ratio, and it would differ across different industries that we're looking at. The second thing we talk about is growing per share value over time. I think a lot of times people mistakenly think that value investors are kind of destined to own only subpar businesses whose best days are behind them. And each year they lose a little bit of market share, they lose a little bit of their competitive advantage, kind of what Ben Graham called the cigar butt companies. We have a very different view of value at Oakmark than that limited view of value. We think those companies can be valuable at the right price, but we think that's far too constraining a universe. And one of the things that we look for is a company that the combination of dividend yield and annual per share value growth at least matches what we expect to see for the S&P 500. So when you think about value, a lot of times people set up what I think is a false comparison of saying value versus growth. To us, growth is an attribute of value, and it's necessary for an analyst to look at what the growth prospects are for a company to help determine what the appropriate multiple is. So we will not constrain our universe at Oakmark to only those below average companies that happen to sell at very low PE ratios. One of the most important parts of this is, how do you find value? How do you find something that's cheap and still growing faster than the market? A lot of times it's based on what management does with free cash flow generation. So we might find a company, say the S&P is growing earnings at 5 or 6% a year. We could have a company that's only growing sales at 2 or 3%, but is a big excess cash flow generator. I think of the banks as an example of that today. And it's important to us that management consider the whole array of opportunities of how they can invest that cash flow, including things like share repurchase. So we want them to be thinking about per share metrics when they think about maximizing value and maximizing growth. Oftentimes our companies will be a business that's growing at 1 or 2% a year on the sales line, but the share base is shrinking 5 or 6% a year, so it's actually growing earnings per share faster than the S&P. Third, managements that think and act like owners. We spend a lot of time looking at what management's economic incentives are, their personal incentives. How are their pay packages determined? Do they have to own a lot of stock? Have they chosen to own stock? Do they have options positions that will benefit them at the same time they're benefiting us as outside shareholders? Are there incentives tied to things like return on invested capital that we think benefit outside shareholders, as opposed to what I would call more like a professional management rather than an owner-oriented management, where they might be incentivized to just grow the sales line of the company, become a bigger enterprise, and the management might be focused just on growing the scale of the company so that the importance of their job grows and therefore their pay package grows. We would much rather be invested with a management team who will make more money if the stock price goes up and we benefit. So we spend a lot of time looking at, is a company generating capital, or does it have to invest capital to achieve their sales growth forecasts? And we make assumptions about how that capital is utilized that all go into determining our estimate of intrinsic value. We want managements to think when they have to raise capital about the fair value of the company and be reluctant to issue shares when they think their stock is trading at less than fair value, and maybe opportunistically would want to sell shares when their stock is above fair value. Of course, if it's above fair value, we would hope and expect we wouldn't be a shareholder. It's important to us that management gives evidence that they're willing to do those things that benefit us as an outside shareholder that might not make their job a bigger job. So something like investing capital in share repurchase when that's the highest return opportunity, to us is a good example of a management team that's behaving like an owner.